Good afternoon, everybody. Thank you so much for joining us today. It has been a great day so far. I hope that you've all enjoyed the panels. Let's start with a round of introductions. Eva.
Hello, everyone. Great to be here this afternoon. My name is Eva Lawrence. I'm the head of EMEA for Figment. Figment is the largest institutional staking provider, helping everyone from banks, asset managers, custodians, and digital asset treasuries to stake their assets and their customers' assets. We have over 18 billion in AUS and over 1,000 institutional clients.
Hey, everybody. Good to be here. My name is Christian Lopez. I head the digital asset team at Cohen & Company Capital Markets. Cohen & Company is an investment bank focused on frontier technology. My background, spent my career at UBS, Guggenheim, and then went over to Cohen to lead the fintech practice. And, at the time of launching the platform, this was in 2021, we realized that most of Wall Street had turned its back on crypto. And I've personally been in digital assets, Bitcoin, and some other tokens personally since 2016, had known some of the founders and investors in the space and realized these are genuinely intelligent, smart folks who are building on a revolutionary technology. So we said, they deserve and need access to the capital markets and advice, just like somebody in healthcare or in technology. So we took a bet, and it's been a fun ride. This year, we've raised over $11 billion for our crypto clients in the public markets and private markets through SPACs, IPOs, DATs, and M&A.
Hi, my name is Amy Oldenburg. I head our global emerging market investing business at Morgan Stanley on the investing side. I also sit on the firm Innovation Council focused on digital assets. I've been at the firm for 25 years. Early on in my career, I also traded EMFX, and many of my counterparts at that time went over to the crypto side very early in the era of the global financial crisis when lots of us were losing our jobs and EM got a little bit less popular. But that's all come around, and we'll talk about some of that today.
Hi, everyone. I'm Melinda Dellis. I lead our institutional partnerships and strategy at Anchorage. That is a go-to-market function. I'm very focused on how to grow our institutional client segments around our core custody business. And so Anchorage Digital is a platform for investing in digital assets. The very unique thing about Anchorage is that our custody platform sits under a U.S. federal banking charter, which we are the first and only to have that charter. But we also have a platform all around that helps institutions, whether they need to execute, stake, and do a lot of other lending-related activities and things as well. So very happy to be here.
Thank you, panelists. And I'm Stephanie Ramazan. I am founder and CEO of the Crypto Collective. We're the world's first strategy, growth, and communications consultancy focused purely on institutional digital assets and blockchain. We work with traditional banks, asset managers, and funds coming into the space, as well as crypto-native businesses in their expansion, and everything in between, including infrastructure providers, just like Figment. I have a background originally in traditional financial markets, first on the capital market side, then more corporate finance. And I went into crypto in 2018 with one of the first banking startups in London looking to offer services to companies in the crypto space before falling down the proper crypto rabbit hole and joining Gemini, the exchange and custodian. So without further ado, let's move over to our panelists. Amy, I'm going to open with more of an open question for you. You're obviously our emerging markets expert here. You're also an expert on stable coins and how they have completely revolutionized emerging markets. How do you see digital asset treasuries fitting into that picture? And could they more broadly bring a totally different kind of stimulus to the market?
So as an emerging market person, and in my years of speaking, I typically would say emerging market people want to be as far away from traditional finance as possible. That's like actually the ethos of crypto working in the emerging market space is in places where governments are not operating in your favor or banking and financial institutions are against you. You want to hold your keys, you want to hold your coins, which is what we've typically seen in the past. But it's been interesting to see this year, 2025, really kick off this era of digital asset treasury companies. And I think the one thing that maybe I would just focus on as it relates to emerging markets, and I think you're seeing some people come to, if it's Korea, or other areas in Taiwan. You see this across Africa, looking for any company that you can turn into a digital asset treasury company. I think that's, in some ways, it's interesting. But I think the one thing for me that would really be fantastic to continue to see growth beyond what we've seen this year, not just an accumulation strategy, but true treasury management strategy. I think there's a real opportunity for emerging market companies to be thoughtful about treasury management, what exposure they have in that treasury. Maybe it's Bitcoin, maybe it's Ethereum, maybe it's some other token that's related to their business. And that very much is a part of their long-term strategy there. I just don't think we're there yet. I think we're very early in this, and I'm sure other people have other thoughts.
Thanks, Amy. Let's now zoom in a little bit more. We have such an incredible selection of panelists here. If anyone is thinking of launching a digital asset treasury, you have pretty much everyone on stage who can help you from start to finish, whether it's Christian raising money, Melinda with the infrastructure, Eva over there making sure that you're getting rewards and being able to stake. So Melinda, first, let's talk about what you think the digital asset treasuries really want these days. What are priorities, and do those priorities differ depending on the type of treasury that they are?
It's a very good question. We are seeing it really does depend not just on the type of treasury, but also where they are in their life cycle. So at the core of what we're seeing in terms of demand, having a regulated custodian that meets the higher standards of security and has the right infrastructure set up to allow corporate treasuries to meet their compliance needs and their auditors' needs is key. So one thing that we see right off the bat often is segregated account infrastructure under custodian is key. So this is actually a part of being an OCC chartered bank. We need to have accounts that are segregated. They're never commingled or rehypothecated. That's all part of the standard regulatory setup with a bank. So there's unambiguous bankruptcy remote status with those assets. But in terms of facilitating the corporate treasuries that are taking the pipe route in terms of getting investor funds, those segregated accounts actually become critical to actually facilitating that process of taking investor funds. So investors' assets are held in segregated accounts unique to those investors. Those wallet addresses can actually be audited by the investors so they can feel comfortable throughout that whole process. We've also been able to facilitate unique structures where the accounts may be held in the client's name and have control agreements around them to give them extra assurances. But this is one application of the infrastructure early on that helps these digital asset treasury companies to effectively raise assets from institutions. From there, very quickly, the needs for execution starts to come up. And actually, there's a very good example of a digital asset treasury company called ProBTC. It's the one led by Anthony Pompliano. We helped them to execute a purchase of Bitcoin earlier in the summer. This is far ahead of the actual SPAC transaction. And their objective with that was to purchase Bitcoin at a moment that they thought was advantageous, and any potential gains that would come from that, they could offer to shareholders who would choose to go along and participate in the SPAC process, give them extra participation in the new shares through any potential appreciation from the Bitcoin. So we were very happy to partner with them to help them make that acquisition. Again, that is something we have an execution desk that can purchase large amounts. We can be very sensitive to making sure that flows are not communicated across the board. But execution is a key piece, whether it's early on and part of their strategy for coming to market with a successful SPAC strategy, or later on when they're looking to purchase and deploy assets into their treasury, we can help as well. And it grows from there. But I'll stop.
Thanks, Melinda. Eva, how early on in the process do some of these DATs come to you to talk about staking? I imagine it might be even at ideation time, or are there people like, oh, we've launched, we better stake some of these assets, and everything in between?
It's everything in between. I would say the first question that the DAT is solving for is always custody, right? And so they will go to their qualified custodian, that will go to Anchorage, and we have the pleasure of working with Anchorage, and they say, okay, we figured out how we are going to custody our assets. We have the segregated setup, but now we want to earn rewards. Now, it's always the fact that you're going to have a DAT that's familiar with the underlying token. Well, you would hope so anyway. So they are already familiar with how much they're going to be earning in terms of rewards, how maybe that's changed over the last 6 or 12 months. So they're going to come in and check off custody and then look at rewards that they could be earning and then how much they will anticipate that they will be staking and start to do some projections, some forecasting off of the back of that. I think that what we have seen is that you have a DAT that might look at staking, lending, DeFi, a number of factors, and put all of those building blocks together to look at how they're managing their treasury. But if the best case, they come to us early on, give us an idea of what they're looking to stake, as in how much, how many tokens, how they expect that will change over time. And then we help them with that forecasting, and they put that together with the other building blocks to understand, okay, what risks they want to take in other areas in terms of lending, DeFi, given that staking is, say, the least risky of all of the assets. It's not quite your risk-free rate, but it's as close as you're going to get to that. So they'll start with that as the base layer and build off of that in terms of treasury management.
Okay. Christian, what separates DATs that get funded versus don't get funded? What's the special sauce, if you will?
It's a very good question, $1 million question that a lot of my clients ask me. I think first of all, timing is a really important factor. We actually did the ProCap BTC SPAC and structured that deal, which was really fun to work with Anthony and Jeff Park. The reality of the situation is, like, in November of 24, when the new administration got elected, the capital markets opened up completely to crypto. And, at that time, I think heading into early 2025, I'm being a little facetious here, but anybody that wanted to start a crypto treasury or a digital asset treasury company can go out and raise a ton of capital, right? Like there was, we raised $750 million for David Bailey and Nakamoto, another $750 for ProCap. The Jack Mallers deal with Cantor Equity Partners raised in total $5 billion. A lot of that was in-kind Bitcoin. And why did that happen? Well, because it was a unique strategy at the time. And the performance of the stock after announcement would do really, really well. In some cases, Nakamoto at one point 30x'd. And so I think that investor appetite and the psychology of the stocks performing extremely well drew in a lot more capital. Where we are today, the market has softened a little bit. And again, it's timing, right? A lot of folks have taken their cue from the ProCaps, the Nakamotos, and said, well, we want to start a digital asset treasury company ourselves. And despite having maybe a very, very good team, a really good strategy, it's a little bit harder because of a lot of that liquidity has been spoken for in the previous deals, and investors have chosen their horses. But I think all in all, to answer your question specifically, timing is an important factor. Team, who you are, what else you bring to the table. Can you speak to institutional investors, and can you also speak to retail? Because in a lot of cases, crypto still is being picked up in the capital markets by the retail investor base. And then, of course, the execution strategy is extremely important. There's been several DATs that have, call it, fumbled the execution of their deal post-market, and it has led to an underperformance of the stock. And so having a very clear plan of attack post-market, which is not easy to do, is really important. And frankly, many of them have fumbled it because they're not capital markets folks. A lot of these digital asset treasury sponsors, they're crypto native and they're smart and intelligent and hardworking. But the reality is having somebody on your team that has had true capital markets, equity capital markets experience is a critical component to, I think, selling the story to PIPE investors and therefore, and after retail.
Absolutely. It's a blend, whether that's the management team, also the board that you have around you. You do need both sides of the coin. And that's very clear from all the DATs that we've seen this year. Amy, we talked very briefly outside about tokenized uranium. We won't go too deep on that one. I already talked to everyone earlier about it. But conceptually, how do you feel about DATs that are going maybe just purely towards commodities? Let's take Bitcoin and Ethereum out of it for a while. Can you see a world where it's, giving access to those commodities like uranium and other assets that traditionally have been very, very hard to access? Could this be a perfect vehicle for that?
Yeah, I think there's a lot that rhymes with the old era of closed-end funds from like 20, 25 years ago. So back when I started the emerging market business, we ran tons of closed-end funds. We ran a Pakistan closed-end fund, an Africa closed-end fund, a Turkey closed-end fund. And one of the reasons we ran those closed-end funds is because foreign investors could not get access easily to those markets. So what we would do is almost the exact same thing that DATs are doing. We would invest in those local assets where we had accessibility, the infrastructure to do so, and we would create the vehicle. We would raise capital one time. If it traded at a premium, we could raise more. If it was at a discount, we would buy back. This all sounds very similar to the digital asset treasury company model that we see, but there was a reason for it. And not all investors would use it, but for many investors, it was a very easy vehicle to use that. And even over time, as we got other ways to access different investment opportunities, there were still some investors, and today there still are those investors out in the market that like to trade and like to look at the arbitrage opportunity around closed-end funds. I think you could easily see that opportunity in DATs going forward. I know some of the funds already do that. They select, as you were saying, they pick their horses for long exposure, but you can also trade or take active positions around your exposure to DATs in the same way that we do that in closed-end funds. So I think they'll continue to exist. There's lots of different opportunities to leverage that vehicle. Even as you have, say, if it's tokenized uranium, you might see a DAT with commodities in there. And I think that you can have use cases for various channels of investors to access that.
Can I actually make a comment on it? Because it's really interesting, the tokenized commodities, and it's like a big thing that's popping up. We actually did a tokenized gold DAT with Antalpha and Tether. And it was great. We launched the product, but I think one of the challenges is how do you generate yield onto the underlying and eventually into the equity that is above and beyond the yield that you can get just holding the underlying, or for example an ETF or a closed-end fund. I mean, accessing uranium, there's uranium trust. There's obviously the GLD ETF. If you're doing tokenized gold and you're doing it through a DAT, in a lot of cases you might trade at a discount because you do have public company expenses. It's a management team that has execution risk, that has salaries, that has public, the legal fees, et cetera. So if you're going to do a uranium or a gold or whatever tokenized commodity ETF, you have to be able to prove to the market that you can generate outsized yield in order to not trade at that discount, because there will be that ARB opportunity, as you mentioned.
Or to just need access in the first place. I think gold is very, very different to uranium, right? More or less, everyone can have some sort of access to gold.
Can I just, because one of the things you were talking about also is the regulation hasn't caught up in certain areas, right? So even though we have this deregulation cycle that we're going through, many fund structures, if it's in U.S. regulated funds, European regulated funds, you probably can't hold tokens, and that's my issue, because I would uranium is something that we would like to get exposure to. Having pure uranium, you get more direct. Some of the trusts don't trade. The correlations aren't always high there, so you're trying to get the purest exposure you can. The token looks super interesting, but some investors are even looking at creating total return swaps on the token because they can't actually use the token right now. So we do need to play a bit more catch up on some of the regulations in other areas of the market.
Encouraging in a way that old school big institutions want access to the token, the mechanics and everything that comes with that. discouraging that they can't have access, and ironic that we have to create total return swaps or other ways to engineer people to have access. So I think it's going to be very interesting how this plays out in the next few months. Melinda, let's go back to you. I mean, Anchorage has always sat very much at the intersection of innovation and regulation. What do you think are the biggest barriers at the moment for a player like Anchorage being able to service DATs to the best of their ability?
Well, I'll start this off by saying I think that we are actually well positioned to serve a lot of the core needs right now. And one of that is being very forward looking in terms of the setup of the banking charter includes explicit authorization for activities that DATs actually do need. So staking is one of those in there. Settlement to facilitate trading being settled back to custody is in there. And of course, custody is what is in there. So, the core needs at this moment, as I was talking about before, you have custody, you have trading, being able to stake directly out of qualified custody, which is where we partner with Figment. That's a key need that you need to, DATs want to stay within the regulated custody ecosystem, whether they, of course, they're not subject to the requirement to use a qualified custodian, but a lot of the benefits, things that come along with that are needed, and certainly to meet their auditors' obligations. So what's going to come down the line, though, is, as participants were talking about, is this demand to generate yield. And eventually, you do have multiple parties. It's how do you generate yield in a differentiated way? How do you really tell a unique story and be able to build a very committed, educated shareholder base that understands your strategy and is willing to ride through market volatility. The way that, to his credit, Michael Saylor with strategy has really done. That's one of the core reasons, I think, why they've evolved, is having a really clear value proposition and really educating their shareholder base and having a very committed group. So as clients now start to look to generate yield in the DeFi ecosystem, we are absolutely looking to service these needs in the ways that we can. There is one recent announcement that can give you an idea of how we've done this. SharpLink, another digital asset treasury, Anchorage served as the custodian for their partnership with EigenLayer. So they deployed about 200 million in ETH into EigenLayer restaking protocol, and they can keep those assets in Anchorage custody while they do that. So that is one of those ways that we are looking to move forward and support as these stats go forward. But I'm sure there will be a lot that they will be asked that they're going to stretch the limits. And that's actually I think that's a core benefit of the digital asset treasuries, is they are pushing and driving the evolution of the ecosystem, which will be used by other client segments down the line.
Eva, you have barriers given that staking is one of the most misunderstood areas of the ecosystem. I know that you spend most of your days at some point explaining the difference between staking and yield generation and rewards, et cetera, et cetera.
Lending. Yep.
Lending. We won't give everyone a 101 just now, but I mean, Figment have done incredibly well. You're the biggest, I believe, staking provider, non-custodial staking provider out there. You've got a great partnership with Coinbase, which is a brilliant signal to the market. But again, coming back to barriers, how much of it is a barrier to you, let's say, education around what staking actually truly is, and getting people to allocate a reasonable amount of that treasury to staking?
So I think for us, it's education, as you say, but also separating out these issues and these topics. Let's not lump all yield together. Let's not lump all DeFi together. Let's be very clear on what we're proposing for a DAT to do in terms of treasury management. So what we are focused on is what portion is pure non-custodial protocol staking, i.e. there is no transfer of title, and working with risk teams, compliance teams, and the regulators. We spend a lot of time with the SEC, the FCA, VARA, explaining to them why non-custodial protocol staking is not the same as, a DeFi lending pool. So I think just keeping a clear delineation is very important. So we don't merge these topics just because everyone likes to put everything under, a DeFi category or the yield category because it's easier or quicker to do so. Just keeping that separation, that helps a digital asset treasury firm look at how they can really optimize their treasury. And coming back to the points earlier, I think that also on the custody side, collateral optimization will be key, and is another barrier that we're seeing for the institution. So you can't stake assets you don't have, right? You have to have the assets in order to be able to stake them. But I think we'll see more and more demand for the optimization of those assets. So if I have staked my assets that are sitting in Anchorage custody and I've staked them to Figment, then what if I use those assets as collateral to trade on an exchange or as a collateral for a loan? I still earn the rewards. I still earn those staking rewards, but I'm maximizing the potential of my collateral by using it still within Anchorage's custody to lend or to trade against. And I'd say that is maybe one of the barriers that the institutions are seeing, is how do you really optimize that collateral, retain liquidity, and earn staking rewards. So that's an area that I think we need to crack as an industry. And I think that will enhance the returns of not only DATs, but, ETFs and across the industry in general.
Amy, you must have come across this all the time in terms of optimization, especially in emerging markets. Do you have anything to add to what Eva said, and maybe some lessons that could be learned from your years in emerging markets, and this really being an emerging market in itself?
No, I was laughing as you were talking about, to myself, it really is. It's just trying to figure out that lending piece. I think this is one area where people are just concerned generally, even with the topic of stable coins, because if this really impacts the deposit base at banks, we need to figure out what the new lending model looks like. And for that, you need to really figure out this collateral piece. It gets very complex very fast. I feel like it's very hard to just have a general conversation. You start trying to explain this, and then next thing you know, you're in like technical discussions very, very quickly on this, which I'm sure you do every day.
Yes, exactly.
Christian, let's come back to you. A couple of questions you can answer in any order you like. What are we going to do with the DATs that are seriously underperforming? I personally have concerns that they could be quite damaging for the industry in itself. We have DATs out there that are trading significantly below where they should be, partly because of maybe the reasons that you've already mentioned. But will these DATs perhaps become M&A targets themselves, or is there a way for them to recover before that happens?
It's a great question. I definitely think there's going to be M&A. It's still early in the cycle. I think for those who have participated, it's probably felt like 8 years that we've been in DATs, but it's been 8 months. And as a matter of fact, there hasn't been one SPAC DAT that has actually closed and is trading, freely. The DATs that have closed have been more like the pipe deals where you go issue a bunch of stock at the market. Why is it underperforming? I think lack of liquidity. Early on, there were only a handful of DATs, and the market available to those DATs was kind of fixed. I think today that market size for DATs is probably similar, if not lower, because of their performance, but way more DATs. So kind of the trading volume per DAT is lower than it was 5 to 6 months ago. So that's kind of why you're seeing that loss of liquidity, loss of volatility in the equity capital markets for some of the DATs. But that presents opportunities for the ones that are performing well, right? So I think like any industry where there's a boom, folks take the opportunity to take advantage of the markets when they're open to them. There's going to be winners, there's going to be losers, and ultimately a good way to acquire coins without necessarily moving the market is through equity swaps. So like even if you're trading, there's two DATs, let's call it sold DATs, one's trading at 0.9, one's trading at 0.7. The one who's trading at 0.9 could acquire the one trading at 0.7 for 0.8, and it's accretive for both, and it's a good deal. And ultimately that will accrue, and then you hire folks like Figment to go do yield strategies, lending strategies, et cetera. And there will be winners. But I do think like ultimately in like the topic of closed-end funds, like and like BDCs, we talk about that a lot, right? Like these are permanent capital vehicles, or supposed to be permanent capital vehicles, and they act a lot like closed-end funds. Ultimately, I think they're going to have to find other ways to generate value and yield to overperform, because it doesn't really make sense for a digital asset treasury to trade much above its NAV, right? Unless it is generating some yield, but a 1.5 NAV or a 2-point NAV isn't really fundamentally sustainable over time. And so how else can you generate value? I think folks are starting to add their own validators. Some people are talking about like the Berkshire Hathaway of the DAT. So buying operating businesses that are generating cash flow, that natural cash flow, not necessarily, crypto or, DeFi cash flow, to actually accrue more of the token over time and diversify.
Can I just add a point on that? Because I was at Strategy World earlier this year. And I think the one thing that really surprised me at, MicroStrategy, or Strategy now being like the largest DAT, I ran into people at the conference that were there for Strategy's software and knew nothing about Bitcoin. And they're like, oh, the Bitcoin piece is really interesting. I'm like, I didn't realize there were people here. I mean, the whole conference is orange. The whole conference is pro Bitcoin. And there were people there that were actually there for the software. So it's interesting to your point on like actually having these cash flow generative businesses. Maybe it's not the greatest example, but it was still quite fascinating to me that there are these companies that have businesses and they're able to buy that with the cash flow that's kicking off from their businesses.
It's happening live. Like we're fielding questions from DATs who are our clients or otherwise, who are like, hey, like, do you know any business out there that would sell to us? Because we want to generate more. It's hard, especially Bitcoin. Bitcoin doesn't have a native yield like, a proof of stake protocol like Solana or Ethereum. You have to go out and do some more esoteric synthetic strategies. The more simple one is lending. You could, sell covered calls. A lot of people do that, and maybe some more unique things that Anchorage you guys help, put together. But it's a very, very live and dynamic situation. People thinking about what's the next step, because while there will be M&A, people aren't ready to throw in the towel, right? It's only been like 8 months. And it's nice. You have a nice salary. You also, I think there's a point of pride and ego where you just raise 200 million or 500 million from investors, and throwing in the towel this early seems, like you're giving up too quick.
And with some of those, the ones that you worked with that have had the big pipes, are they already coming back to you? We need to raise more. And then what would you say to them if they're really underperforming?
I tell them it's a tough market out there, and you're going to have, you got to find ways to bring your MNAV up. I think it really depends on what the DAT is. Like if it's a Bitcoin DAT, and it's, Bitcoin is fully liquid, there's an ARB opportunity there for investors. But there's also technical overhang. Like some of these DATs raised, to your point, $500, $750 million. There wasn't enough liquidity for those initial pipe investors to sell out of their position. And what we ended up realizing ex post facto after the pipe raise was that these weren't really investors that financed the DATs. They were traders. They saw the quick buck, and they wanted quick turnover. And in high interest rate environment, DPI is more important. And people are trying to return cash back to their investors and flip to the next deal. So some of those people are still stuck, right? So anytime that there's a day of good volume, and you start to find an investor base that picks up that discount, that tries to arb out that discount, you're seeing some of that pressure push down the price.
Very interesting. Can't wait to see how it all unfolds. We only have just over 5 minutes left, so I'd love to just turn to all of my panelists and just get your thoughts on outlook for 2026, whether it's going to be more of the same or a complete revolution.
I do think that there is going to be some interesting progress in the DeFi ecosystem with DATs in particular. And the angle of that I think is interesting is, we've kind of two sides of the spectrum when it comes to corporate treasuries. The part that might look more like a traditional treasury that is really using Bitcoin, for example, as a strategic reserve asset. But then you also have some of these DATs that are coming from the protocol and foundation ecosystems, and really how they can promote the development of those ecosystems in a unique way, being a public company. So I am interested to see kind of what these strategies come out, and how certain DATs whose reason, their mission really is to be very much engaged in the on-chain communities, how they can do that and how that will be different from what we've seen in the past. And doing it in a public vehicle, you have a level of transparency and regulation around that I think is very unique for investors who've been supporting these ecosystems in the past. And so I'm very excited to see how Anchorage can participate in that, but also how the industry really evolves through that.
I think it's going to be more of an evolution. My guess is there's probably going to be a headline out there that says like DATs are dead at one point. But it's just going to be more of a cleaning up of certain things that may need to not be part of the area. And then there's still a ton to build. And I mean, there's, good examples of things that still need to happen going forward. So, I think we are still at the beginning here, but it does feel like 8 years, even though it's been 8 months, I would say.
This question's tough for me to answer because I'm wrong 95% of the time when I try to predict what happens.
Stephanie said the same thing at the start of the panel.
But I think the regulatory environment is open for crypto, and from our investors, they're asking for more. I think the DAT market is taking a pause. And so they're kind of, like, hey, let's take a look at operating companies. Like who are and what are the businesses in the crypto ecosystem that are generating a tremendous amount of cash flow that we can go fund? And I think there's plenty of them out there. But because it was such an abrupt change in the regulatory environment for crypto companies, they just weren't ready to go public. One of the biggest bottlenecks for any company that wants to access the public markets is being PCAOB audited. And that takes a long time. And then companies who are in crypto tend to be a little bit more complex because of all the transaction revenue, the blockchain data that you have to audit. So they're coming. I think next year, and you're starting to see this, by the way, you're going to see a lot more opcos access the capital markets. Sure, maybe a DAT here or there, but folks, like custodians and staking providers and other exchanges, lenders, prime brokers, asset managers, you're going to start seeing a lot more of that.
Yeah, I think we're going to see consolidation across the market, including DATs, right? But that's healthy. That's good. That's what we need for healthy growth in the market. So I don't think it's necessarily anything it's not a negative. It's not this is bad for the industry. I think that's what we need to kind of maintain a healthy market, and we will also see the same in the the ETF space. Not every ETF is successful, so I think we'll see that across the market. I also think that yield optimization will be key. To make a DAT stand out, you will need to be doing over and above in terms of managing that treasury. You can't just sit back and collect staking rewards and that's it. And as Christian was saying, what other income is being earned, that will be key for these DATs and their survival. And then I also think another area that we'll see growth in is the non-ETH, Solana, and Bitcoin DATs, right? Obviously, those are the three that are the most talked about. In the last, say, 3 months, we've seen a lot more interest in Solana, in particular because the staking rewards are quite high. But I think we will continue to see foundations from protocols that maybe the people in this room aren't as familiar with suddenly tell us they're launching a DAT, or JVs between two companies who decide that they have a particular thesis around a token that has a very high staking rewards rate or is generating a high return in terms of DeFi activity, and so they decide to launch a DAT. So that piece, I think, will continue to grow for better or for worse, and it will be smoothed out by the consolidation across these DATs as the space grows.
Thank you. Well, just as a closing thought, I just want to acknowledge everyone on this panel and many people in this room. When I think how far we've come as an industry in digital assets over the last few years, it's really absolutely astounding. I mean, the fact that DATs are publicly listed vehicles and that we've had so much M&A activity and other companies going public this year is really a testament to the people that work in the industry and the people here on this stage, their resilience, their grit, their determination, their open-mindedness, their intelligence. Sticking with it because, you know, we all had a gut feeling at some point. And look, at least people still say I'm crazy, but not because of crypto anymore. So thank you to everyone and thank you to Beryl Elites for putting this conference on today.
Thank you.
Thank you.